We'll now begin with reading number 48 of the level 1 curriculum that will give us an introduction to market efficiency. So when we say market efficiency, in general, we mean informational efficiency. So in an informationally efficient capital market, security prices reflect all available information fully, quickly, and rationally. The more efficient or the more informationally efficient a market is, the quicker its reaction will be to new information. So at any point in time, stock prices discount available information about a company. As new information hits the market, the stock prices fluctuate so as to incorporate that new information. That is, traders buy and sell securities based on the new information so as to adjust, and which results in the adjustment of the price of the security. In an efficient market, this process is quick as soon as the new information arrives. Only unexpected information should elicit a response. What was already expected should already be in the price. So if a news flow comes, you're expecting GDP growth to be 5%, and the actual announcement comes and the GDP growth is 5%. So in an efficient market, a news like this should not elicit a response. However, a surprise positively or a surprise negatively should result in a response from traders and should result in prices adjusting. If the market is fully efficient, that is, this new information is quickly discounted into the stock price, then active investment strategies cannot earn a positive risk-adjusted return on a consistent basis. And theory advises that investors should follow a passive strategy. So if the market actually discounts new information in a quick manner, then trading actively will not be able to generate excess return. So what is argued is that anyways, if there is a stock A with a current price of $10, then all available information is anyways currently discounted in this price. So whatever analysis you can do so as to buy or sell this stock, all that analysis based on all that information that is available right now is already discounted in the price. Only new information can move this stock price up or down. And on that new information, you have no handle or you have no access. So new information, when it comes, by the time you study and analyze this new information, the stock would have already reacted. So there is no way that you can outperform the market by active trading or by analysis, because all that you know is already discounted in the price. So buying and selling right now should ideally not happen because the current information is in the price. New information will move this, but you don't know the new information, and by the time you analyze the new information, it will also be actually discounted in the price, so the stock would have already moved. Hence, active investment strategies cannot earn a positive return consistently. Investors should basically replicate the benchmark or just replicate common indices rather than wasting time and money on active management. An asset's market value is the price at which it can currently be bought or sold. So this is the current market price, also known as CMP. An asset's intrinsic value is the price that investors with full knowledge of the asset's characteristics and cash flows would place on the asset. So the intrinsic value is also known as the fair value, or this is the price that an investor would ascribe to the stock today based on the fundamental analysis of its characteristics. In an efficient market, there will not be a very big difference between the market price and the fair value. So essentially we've seen that if there are a large number of market participants and greater information availability to everybody, then the markets will be more efficient. That is, the current market price would converge to the intrinsic value or the fair value. If there are impediments to arbitrage, to short selling, if there is high brokerage, high costs of getting information about the companies, about the stocks, then markets will be less efficient and prices may deviate from their intrinsic values. Hence, to boost efficiency, regulators across the world try to reduce impediments to information and dissemination of information. They try to encourage dissemination of information equitably to all investors. So exchanges across the world mandate that for any listed company, any important news should first be disclosed to the exchange. Once that has been done, the company can disclose it to other sources or put it on the website, etc. But first, disclosure has to be made to the exchange so that all investors, big or small, receive the news at the same time and the market is efficient. That is, the current market price quickly adjusts to the intrinsic value or is the same as the intrinsic value. That is what efficient market is. The weak form of efficient markets hypothesis states that security prices fully reflect all past price and volume information. So, analyzing historical price movements and historical volume of trade will not add any value. So, you cannot predict future stock prices by analyzing past trends or past price and volume data, essentially saying that technical analysis is not useful. Technical analysis will not help you generate excess return. The semi-strong form of the efficient market hypothesis states that the prices fully reflect all publicly available information. So it's not just price and volume data, but all public information. All public information, for example, the balance sheet, the cash flow statement, the income statement, any news flow, expansions, acquisitions, whatever company has disclosed, all public information is discounted in the stock price today. Hence, analyzing balance sheets, cash flows, or doing fundamental analysis is also useless, or it will not give you any excess return. The strong form of the efficient market hypothesis states that the security prices fully reflect all public as well as private information. So public information as well as private information is discounted in the stock price. So even having insider knowledge will not help you make excess return. So the weak form says price and volume data is discounted. So technical analysis will not result in abnormal returns. Semi-strong form says that all public information, balance sheet, earnings, strategic acquisitions, etc., are already accounted for in the stock price. Fundamental analysis of these things will also not help you make abnormal return. The strong form says that price, volume, fundamental analysis, as well as private information is discounted in the stock price, and analyzing any form of information will not give you any excess return. So once again, if markets are weak form efficient, then technical analysis does not consistently result in abnormal profits. If the markets are semi-strong form efficient, then fundamental analysis does not consistently result in abnormal profits. However, fundamental analysis is necessary if market prices are to be semi-strong form efficient. So even though you doing fundamental analysis is not going to help, but somebody has to do the fundamental analysis so that the price quickly readjusts to the fair price. So the argument essentially is that there are so many people doing fundamental analysis that you will never be the first one, or you cannot be the first one to do the fundamental analysis and trade on it. So the price would have already reacted by the time you do fundamental analysis, because that analysis would have already been done by somebody and be discounted in the stock price by the time you make something of it. If markets are strong form efficient, then active investment management does not consistently result in abnormal profits. This essentially means there is no way that you can earn excess profit. Even if you were an insider, even if you had information that the public did not have, you still cannot earn excess returns. Now, if the markets actually are efficient, if the markets are strong form efficient, then do portfolio managers need a job, or do they add any value at all to their clients, is the question. The theory says that even if markets are efficient, portfolio managers can help their clients by understanding the risk and return objectives of their clients, assisting them with asset allocation, assisting them with diversification, and following strategies that minimize taxes, etc. So they don't need to be trading in and out all the time, because that kind of activity will not generate return if markets are efficient. So they don't have to focus on stock selection and trading and market timing. They should focus their energies on asset allocation, understanding the life stage of the investor, understanding the risk appetite, advising on various asset classes and various options available in the market, and doing things like that. That will be a bigger value add than trading or betting actively on stock picking and timing. So abnormal returns are defined as returns above the CAPM expectation. So CAPM expectations are RF plus beta times RM minus RF, as we studied in the review on portfolio management, or we will study. So technical analysis seeks to earn excess returns by analyzing price and volume data. Generally, we have seen that this does not produce abnormal profits and the markets are weak form efficient. Fundamental analysis is based on public information such as earnings, dividends, accounting estimates. Semi-strong form of efficient market hypothesis suggests that public information is also already in the price. So various event studies that examine abnormal returns before and after the release of new information generally support the semi-strong form of market efficiency. That is, that if you trade after new information has been released and you try to profit from that new information, you are generally more often than not able to. So you may do it sometimes, but other times you'll get it wrong. On the whole, event studies support the semi-strong form of market efficiency. That is, you cannot make abnormal returns by analyzing public information or analyzing or reacting to news after the news has come. Now, there are certain anomalies that we have noticed in markets across time. So these anomalies actually tend to challenge the efficient market hypothesis. That is, existence of these anomalies may violate the efficiency that we have just discussed. So some anomalies are seen in time series data. So time series data essentially violates the weak form that says that analyzing price behavior over time and trying to capture trends in price movements cannot add any value. So these anomalies in time series data violate the weak form of market efficiency. That is, there are certain trends that do persist, and trading based on these trends can actually generate excess return. So the first such trend that we have noticed is called the January effect, or turn of the year effect, which says that stock returns are higher in the first 5 days of January than in the rest of the year. So if we buy at any point in time and sell during the first 5 days of January, there will normally be an excess return. So if we buy in December and sell in January, we would be able to make an excess return. There are various reasons ascribed as to why this happens. One reason is that it is because of tax loss selling. So a lot of investors sell their investments at the end of December. They sell it to realize the losses and get a tax benefit. So they sell in December and buy back in January. Hence, the selling reduces stock prices in December. So if you buy in December and you sell in Jan, you will be able to benefit. Another reason ascribed is called window dressing. So a lot of times the portfolios are published at the end of the year. So a lot of investors don't want to have bad, risky stocks published as a part of their portfolio. What investors do is that they sell their risky stocks in December, so that when the snapshot of the fund comes on December 31, these stocks don't appear on the portfolio. However, they buy them back in January because they expect higher returns. So again, we've seen that this may be one of the reasons why prices are lower in December or returns are higher in January or the first 5 days of January. So if this actually exists for a long period of time, then it means that analyzing past price data does give us excess return, hence it violates market efficiency. We've also seen that overreaction happens. That is, firms with poor returns in the first 3 to 5 years get significantly beaten down. That is, they have better returns in the next 3 to 5 years. So if the stock has continuously been falling for 3 years or 5 years, then we see that it tends to perform better in the coming years. We've also seen some momentum effect. That is, high short-term returns are followed by high short-term returns. Low short-term returns are followed by low short-term returns. So there is some momentum and some overreaction which has been seen. Hence, following these trends can give us some excess return. These are some anomalies that we've seen in time series data. Similarly, we've seen some anomalies in cross-sectional data also. So cross-sectional data is not data over time. It's not price and volume data over time. It is data of all companies as on a particular date. So if we have 50 companies in Nifty 50, then analyzing the characteristics of those companies at a particular point in time would be the analysis of cross-sectional data. The anomalies in cross-sectional data violate the semi-strong form of market efficiency. So what we've seen is that smaller companies, that is smaller market caps, tend to outperform large cap stocks or bigger companies. Value companies have outperformed growth stocks. So stocks with lower P by E, lower P by B, lower price to book and higher dividend yields have historically been seen to outperform growth stocks. That are the stocks with opposite characteristics. That is high P by E, high price to book and lower dividend yield. Other anomalies have been seen in the case of closed-ended investment funds whose values tend to deviate from the net asset values. We've seen anomalies in earnings announcements also. That is, positive earnings announcements are followed by positive returns for the next couple of days. So information may not be immediately discounted. Negative earnings announcement is followed by negative returns. So you can actually trade on these earnings announcements and still make some profit. IPOs have generally been seen to be underpriced. And another violation of the semi-strong form is that the stock returns have been related to known economic fundamentals, that is price to earnings and analysis of balance sheet and cash flow. So some anomalies do exist that challenge the efficient market hypothesis that we have just studied. Now, what we can deduce is that evidence suggests that most of these anomalies are not violations of the efficient market hypothesis. They are rather just an outcome of the methodologies used in the tests. So it's just that either there was higher risk that wasn't accounted for, or there was some mistake in the methodology that we used when we performed these tests so that these anomalies arose. There is both underreaction and overreaction, and it can be argued that on an average the markets are efficient. So again, what we can say after all the research is that these anomalies that we've just discussed are generally transient relationships, too small to profit from, or they simply reflect risk that has not been accounted for. So small companies, for instance, outperforming large companies may be a logical thing because small companies have higher risk also. They can go bankrupt very easily, whereas large companies may give a lower upside, but they have lower downside also. So the anomalies are normally too quick, or the relationships are too small, or the gap is too small to make any meaningful profit from after accounting for brokerage and transaction costs. So the bottom line is that portfolio management simply based on anomalies will be unprofitable. Now you don't need to exactly remember each of the anomalies that we discussed previously, but do have a good sense of the weak form, semi-strong form, and the strong form of market efficiency and what they're trying to say. The last part of market efficiency talks about behavioral finance. So we will have a very brief introduction to behavioral finance. It will be a dedicated review at level 3 of the CFA exam, and we will spend significant amount of time understanding behavioral finance at level 3. So this is just touching the surface of the topic, so not much detail provided. However, behavioral finance examines whether investors behave rationally. That is, psychologically, do they tend to act in a rational, defined, straightforward manner? How investors behave will affect financial matters, and various biases, various psychological biases or cognitive biases may also result in the anomalies that exist. A market is essentially nothing but a buyer and a seller. Both buyer as well as the seller are human beings, and human beings may not at all times act rationally. So they suffer from different states of mind, different psychological patterns that behavioral finance tries to study, and hence the behavioral finance argues that because the buyer and seller have emotional and cognitive psychological biases, markets may not be efficient at all points in time. So behavioral finance describes investor irrationality and the various biases, but it does not necessarily refute market efficiency as long as investors cannot make abnormal risk-adjusted returns on a consistent basis. We will study this in more detail. Now, people have seemed to be suffering from various biases. Details of these biases are not in your curriculum. However, we will briefly discuss some of the biases that people may suffer from. So loss aversion is the unwillingness to accept a loss. So you don't want to sell at a loss, or you don't want to sell securities that have fallen in price, because as human beings you don't like booking a loss. Now, even though the rationale to trade or not trade a stock at a particular price, if stock A is currently valued at $10 and the question is, should you buy or sell? The answer should depend only on the fundamentals and the characteristics of the stock at this price at $10. Whether this has come from 100 to 10 or from $1 to $10 should have no bearing. However, what we've seen is that if the stock has fallen down, then even though the fundamentals may have deteriorated, people have an aversion to sell. Investors often have seen to be overconfident in their abilities, so they have too much confidence in their ability to predict the stock price, to predict the earnings, to predict the performance, which again may cause overreaction, over trading, etc. Other biases include representativeness, where if one IT company is doing well, for instance, we feel that all IT companies have similar prospects, or we buy all IT companies. Or if we feel that the company is good, then the stock will also be good. Please note, the company may be very good, but the stock price may already be discounting the good company, and then the valuation may be right up there. So a good company doesn't necessarily mean a good stock, whereas a bad company may be a very good stock if the earnings are expected to improve and valuations are not that demanding. So representativeness is when we extrapolate one thing to another without a sound rationale. The gambler's fallacy is an again trap that people fall into. So if you toss a coin 10 times and you get 10 heads, what is the probability of getting a tails in the 11th toss? It is 50% or more than 50%. Please know that the probability still is 50%, whereas the gambler's fallacy says that people suffering from this bias assume a reversion to long-term means much sooner. So the gambler thinks that if 3 heads have come, it is more likely that the next one will be a tails. So yes, if you throw 1,000,000 coins, then there will be 500,000 heads and 500,000 tails near about. But in 10, 100, 1,000 tosses, you can say nothing. So the gambler's fallacy is that you expect reversion to long-term means much sooner. Mental accounting is when we base our decisions on incomplete information or incomplete processing of the information. Conservatism is when we do not account for the new information fully, or when we do not want to change our estimates even though new information has come. Disposition effect is similar to loss aversion, wherein we are predisposed to selling stocks that have gone up and holding on to stocks that have gone down. So we don't want to book a loss. Narrow framing again is similar to overconfidence, wherein we feel that we are too sure of the outcome. So we say that best case is 50% return, worst case is 10% return. So the frame is too narrow, whereas in the worst case, things can go much worse. So all these are some biases because of which people may not efficiently process information and stock prices may not be efficient. So behavioral finance says that people suffer from various biases. These people are all that constitute the market. The buyers and sellers in the market are all people who are suffering from these biases. Hence, the markets may not be efficient or there may be anomalies. There is information cascading seen, there is herding behavior seen, there is uninformed investors, there is small retail investors often watch the actions of what the big fund managers are doing or what big mutual funds and big investment houses are doing. So they will try to follow these fund managers. So if one big fund is buying into a particular stock, a lot of investors start buying the same stock, thus causing that stock to become overvalued and other stocks to become undervalued. So this herding behavior and information cascading from informed investors to uninformed investors again may create overvaluations and undervaluations or create anomalies in the market. So on the whole, what behavioral finance says is that if investor rationality is assumed as a prerequisite for market efficiency, that is, if markets have to be efficient, all investors have to be rational, then definitely markets are not efficient, because investors are all human beings who are not always rational. However, if market efficiency only requires, as we discussed earlier, that investors cannot consistently earn abnormal returns, then research supports market efficiency. That is, despite all these biases and behavioral finance concerns, on the whole, we have seen that investors are not able to generate abnormal risk-adjusted return on a consistent basis. Hence, we should not waste too much time and transaction costs on active fund management. Rather, we should focus our energies on asset allocation, portfolio diversification, and follow a passive strategy to meet our investment objectives. So that was about reading number 48 of the curriculum that talks about market efficiency. We'll continue the discussion on equity markets and valuations in the coming sessions and coming reviews. So thanks a lot, and see you next time.